All right, we've got the great pleasure of having Larry Gaines with us tonight. As you can read on the chat room, Larry has extensive background in the options trading area. He founded the Power Cycle Trading site and has got over 30 years of professional trading experience, both in commodities and equities. So he's got some very interesting perspectives on how to make profits with options. So with that, Larry, welcome to the Candlestick Forum. We're anxious to see your information tonight.
Thank you, Stephen, for having me here tonight, and thanks everybody for being here on a nice summer night, hopefully where you are. It's beautiful here in Austin. So that being said, let's get started. So I'm going to talk tonight about, trading options and kind of the income option side of things. So that being said, let us get rolling here. We're going to cover a 5-step plan I put together. Step 1 is avoiding the #1 option trading mistake that is so common. 2, the most important option factor to understand. Also 3 is how to understand option pricing, how that works, so you kind of general feel for the option market. 4, knowing and using the market maker secrets. And 5, highest probability option strategies for every market. So the following webinar is purely for educational purposes. Any stocks, futures, options mentioned does not constitute advice and should not be construed as a recommendation. So yeah, thanks for the intro there. I've been trading for over 30 years, and I was executive vice president for one of the largest oil trading companies in the world, Trans World Oil, and had the good fortune to run their trading operation for over 10 years out of the beautiful island Bermuda. So it's a fantastic living experience for me, plus a great learning experience. And as everybody here hopefully knows, that trading is just a journey of learning and education, because you never really master it. You just try to improve and get better and better. So it was a great learning experience for me, and just experience in general. From there I went on and opened up the over-the-counter crude oil option brokerage desk for PVM Oil London, which is the largest privately owned oil brokerage company in the world. That was just another fantastic learning experience as well, just more in-depth knowledge. I thought I had a pretty good idea of options and trading options, but that really showed me a lot of stuff there. With the various option structures, and then being able to deal with some of the big institution banks and hedge funds. So a great experience as well. My first option trade was back in Bermuda, right here, about a year before this, circa '88. So that's me, good full head of hair. And we started trading options on cargoes of crude oil. And that's where I got my first start with options, and just kind of fell in love with them ever since. And we were selling premium. That was the thing that really drew us and got our interest in options, was selling premium, getting money, putting it straight to our bank account. So we would do that on cargoes of oil. And basically that's what I'll be talking to everybody here about tonight. So first off, though, I also like to just back up a second and like to find out, everybody that's here, would you like to be trading full-time for a living, but maybe you're not quite here or there yet? Just put a yes or no, just kind of like to get a feel for everybody in the room tonight. Well, it's just blazing through with lots of yeses, that's for sure, and some that are already there, so that's great. So, we all have to start somewhere, and I used to be, in there with everybody that's here tonight. So, trading for yourself, though, can be one of the most rewarding jobs on the planet if you're educated about what you're trading, and, you stay focused on your trading risks. But it also can be a very painful profession at times, which I'm sure everybody here can attest to. Now, when I went out and started trading my own account, I had to totally shift and change the style of trading I was doing versus what we were doing for this large prop shop. And when it becomes your own money, those losses are so much more personal. So I had to also quickly learn how to better control my risk. And really my kind of what I call my aha trading moment actually came when I started to incorporate more income type option strategies into what I was already doing. And that's kind of what we'll be focused here on tonight. So first off, though, what is that #1 option trading mistake that is very, very common? Option trading has so many more advantages than trading stocks, but as you probably know, it's also a bit more complicated. And for the individual trader, it can also be a little intimidating as well. Now, that's why many investors trade options by purchasing out-of-the-money options, often on short-term options that are short duration, since they cost a lot less than the long-term options, and it's basically a really simple strategy. So, for example, out-of-the-money calls are especially popular because they can be very, very cheap, and they seem to follow the old Warren Buffett paradigm that we all love and we've kind of grown up with, and that's to, buy low, sell high. But is this always the best option strategy? Well, in this example, imagine you're bullish on Facebook and it's trading at $80. Now, as a beginning option trader, you might be tempted to buy calls 30 days from expiration with a strike price of $100, and those options are going at 15 cents or $15 per option contract. And why would you want to do this? Well, when you do the math, you can see that you do a lot of them. So, for example, if you purchased 100 shares of Facebook at 80, that would cost you $8,000. But for that same $8,000, you could go out and buy 533 contracts of those 100 calls that were going for 15 cents and could literally control over 53,000 shares. So when you look at that, it's just, your eyeballs pop out, and then you go a little bit further and you say, well, what if Facebook was to hit $101 within the next 30 days, and those 100 calls then would be worth $105 or $105 per option contract prior to expiration. You do the math on that, and you can see that you can make over $47,000 in just 1 month. Well, at first glance, this kind of leverage is awesome, but don't let this glitter fool you, because not losing money is just as important as making money in trading. So one problem with the short-term out-of-the-money calls is that you not only have to be right about the direction, but you also have to be right about that timing. Now, this really ratchets up the degree of difficulty, and to make a profit, the stock doesn't just need to go past the strike price, but it also must do it within a defined period of time. So in the case of the 100 calls on Facebook, you need to have the stock reach 100 within 30 days to make your profit. Now, it's this dual objective of having to be right on direction plus timing. This really lessens the probability of an option trading being a winning trade when you're just consistently buying options. And everything that I teach my clients and members is that it's based really on managing risk and increasing the probability of your winning trades. Now, in this Facebook option trade example, you're wanting that stock to move more than 20% in less than a month, and this would be like a 2 standard deviation move. And how many stocks are likely to do that? Well, we'll see, the few oddballs like the Netflix or the Teslas that will go crazy, but not many. And in all probability, the stock would not reach that strike price, and the option would expire completely worthless. So based on probability, and we can use probability to measure it theoretically using standard deviation, there's only about a 5% chance of this stock reaching 100 or to 101 by expiration. So in order to make money on the out-of-the-money call options or options period, you either need to outwit the market or get plain lucky. And we used to always kid around the trading room that there's an old blues song that said, one of the lines was, if I had no bad luck, I'd have no luck at all. And that kind of sums it up in trading a lot of times. You make a mistake and it usually doesn't go in your favor. Now also, being close means no cigar. So imagine Facebook rose to 90 during 30 days of your option lifetime. Now you could say you're right on direction, the stock move, but since you're wrong about how far it would go within a specific time frame, you'd still lose your entire investment. And this is always outright painful when that happens. So based on this trade example, a better goal for every trader, in my opinion, is to select trades based on what provides the most consistent positive returns and not that one-time big winner. And consistency is derived from making high probability trade setups based on reliable data and facts. And where there's a big disadvantage, such as the one you just saw in this option buying scenario, you can usually just look at the flip side of the coin and see an equal opposite advantage. So in this case, being a seller of option would give you a huge advantage over being a buyer of options. And all the pros know this and they'll take advantage of it, and you can too. So as a seller, all the things in this example are the same but in your favor instead of against you. So this is why a lot of people like to take advantage of selling options for income generation. And by selling options, we're in essence selling time. And I like to compare an option to a coupon that must be redeemed by expiration date, or else it's no longer going to be valid. And one other thing too, if you've ever been on the YouTube or used that, Google and search the YouTube video Karen the Super Trader. It was a great interview done by Tasty Traders with Karen Super Trader, and she was started out trading options and just buying options and was never getting ahead. And then all of a sudden the lights came on for her. She figured it out. Hey, I better look at selling options as well. So she did that, and her account was just incredibly huge after she started doing that. And currently she manages a lot of money now for other people as well, just selling options. So it's a great thing to add to your portfolio of things that you're doing. Now, step 2 is the most important option factor for this kind of income generation, and it's understanding the concept of time. And it's kind of simple based on that example if you just look back at it. Now, what is time value? It's used in trading strategies to take advantage of the accelerated time decay of an option into its expiration. And option income strategies are very, very tied to time value and the impact that it has on the price of the option. Now, time value is also referred to as extrinsic value of the option, and it's the premium that a rational investor would pay over its current exercise value, the intrinsic value, based on that potential to increase in value over time. So as a seller, your seller's going to want a little bit more premium to give you that additional time, and as the buyer, you're going to be willing to pay a little bit extra for that additional time. So that's basically the concept, and it's this probability. It's always going to be greater than 0. Thus, options are always worth more than their current exercise value until expiration. Now, we'll take a look at the following chart, and you'll see how predictable and powerful this kind of option time paradigm is, and then just kind of answer a simple question out there. Now, here is a time chart to show that when you're out 120 to 90 days out, that decline of your time decay is very, very small. Now, we also call this theta to measure it. And as you get closer in, like 30 days out to the weekly options, all of a sudden it speeds up and accelerates until you're at 0 before you know it. So out here you'll notice, it's maybe $1 a day, which is a penny or $1 per contract. Then all of a sudden it'll be $5, $10, $20, and then boom. So if you're constantly buying options and you can see that this theta decay is going down like that and you're going against it, you're basically swimming against a very severe swift tide. So it's good to understand the effects of time decay and know the impact that it has. Now, so the question is, if the underlying security price was just to go sideways and really have no direction, would you have wanted to have bought those options 120, 90 days out, or would you have rather sold the options? So you can pretty much figure that out pretty quick. Now, this is the common natural time value progression for all options, and it's like falling off a cliff blindfolded if you're not aware that it's out there impacting your price each and every day. Now, how does that pricing work? Well, the value of an option, the basic components are time value times implied volatility times that intrinsic extrinsic value. There are other Greeks that go into it, but these are the main 3 basic components. And once you know these variables, then you're going to be ready to price the option and know what option premium should be. So here's another table to kind of illustrate time decay. Now, this is a weekly option table, excuse me, and here you have time value times implied volatility times the intrinsic extrinsic equals your option premium. Now, it kept this intrinsic extrinsic 1 so you can see how the numbers flow through. Now, series, and it's got 100% time in it, and so that times your implied volatility times intrinsic extrinsic gives you your option premium. Now you'll notice here, when you go down to Monday, if you're not familiar with it, all of a sudden that time portion of the option is cut in half, and even if you have a big spike in implied volatility, in this case up to 800, it barely budges and pushes your premium up, and before you know it, you're down here at 0. So that's the key. These things can accelerate and take advantage and deteriorate your profits fast if you're just buying. So step 4 then is to understand one more secret that the market makers don't want you really to know about, and that's what we're going to show you right here. So think about markets. They tend to go in 2 to 3 week cycles, just kind of approximately. You'll have a good run up, and then the markets go sideways, consolidate. And they'll do that for 70-80% of the time. Then you might have a pullback and then sideways. So it's based on this sideways price movement that the out-of-the-money option buyers will lose approximately 70% of the time. And the market makers, they know these statistics, and therefore they're going to want to trade to the sell side as much as they can. And this is the professional money, so you need to understand what they're doing, what the market makers are doing, and kind of get in on their game. And it's all based on the math. Now, the market makers use mathematical market probability statistics for pricing the movement of an option to its expiration using a pricing model. And now we all have the same basic pricing model. So, the field is a little bit more level than it used to be. But knowing the probability of the underlying security finishing within a certain range at expiration is key when you're determining what options you want to buy or sell, and then decide on what option strategy to use. And these statistics forecast how likely it is that an option will fall within a certain price, up or down, by its expiration. And it's this statistical forecast. This is referred to the implied move of the stock, and it's the implied move. This is a theoretical estimate of a plus or minus 1 standard deviation move of the underlying security by its expiration. So it's a lot of words, but when you go through this next little slide, you'll kind of see it more clearly. So it's based on these probability statistics that short vertical spreads, or referred to as credit spreads when used correctly, can provide the trader or investor the greatest probability of success, and are one of the best ways to generate a steady kind of stream of income, and you can do it monthly. And it all comes down to the math of probabilities. So in this chart you're seeing here, this is a normal distribution curve, statistics. So it's used for distribution of data or price. And so it's a bell curve. And so what you're going to see here is your option components. So you're going to have the first thing you're needing for option prices. You need to know the implied move, implied volatility. That'll be given to you. And then days to expiration, that's going to be given to you. And then option pricing will always start at the money. So that's on the top here. So in this example of Google, we're starting the price at the money. And at the money is where it starts. And that's where all the demand, supply-demand, starts first. And then the outer strikes are set, calls and puts, and that's called the skew. So it's from this point where all that demand is, you're giving these components. So plus or minus 4%. So 4% down would be a price point of 480. 4% up is a price point of 520, and that's given to you with the expiration in this particular example of 10 days. So basically all this says to the option trader is that the implied move is going to be from $480 to $520, and that implied move is approximately, theoretically, a 1 standard deviation, or 68.2 probability that price will be between these 2 points by expiration. So what this tells the option traders that if you go outside of that too much, then you can see how your probability of a successful trade starts going down even further, or if you go outside of here, it goes down. So the probability of winning gets less and less. And that's why those options are cheap, because the probability of that being a winning trade is very, very low, equaling a high risk. So for that high risk you're taking, you're going to get a big payoff. So that's the basic concept. Now, trading, is a business of probabilities, and to be successful as a trader, you need to focus on controlling your risk. And one important step is knowing the winning probabilities of any trade you're going into. Another really good, simple, and free tool that you can use for this is the option delta. It's a really great Greek, and it will tell you, 1, the value of the option based on the underlying move, and 2, you can use it kind of as a back-of-the-envelope way to measure probability of a price move on the underlying security itself. So here's another example. So if you have an option delta of 68 or 70, that equates to that strike has a 68 or 70% probability of being in the money at expiration or being within a 1 standard deviation move. So an option delta of approximately plus or minus 16 is equivalent to that outside point of that 1 standard deviation move by expiration. So you can see here, again, that 15.9% or 16 close to it is that point there and that point there. So 15.9 chance is that 1 standard deviation point outside there, and then it gets even worse as you go, past that. So that's how you can use that, and I'll show you in this next slide how that all lines up. So this is another slide of Google, and this is using Thinkorswim platform, their option chain platform. And so first off here, you can see the price of Google trade at 582.45, so that's at the money. Now you come over here, you can see days to expiration right here, 22 days. Now here are your strike prices, here's your delta. Okay, so the next thing, what I did here was I put these are called price slices. This is where you can set automated the 1 standard deviation move of an option based on the input here in your model. So putting that in, I set it to 1 standard deviation move here to the upside and 1 to the downside. So that gives me a number, 1 standard deviation up based on all this data of $622.28 or 542.80 to the downside. So there's that implied move, right? Now, the really quick way to do it on your option platform so you don't have to do all this stuff down here, you just go to the strike price down here, go over to the delta. In this case, it's an option calls, and you can see that the 620 strike right here lines up to an 18 delta. So it's a good back of the envelope way to figure probability. So this would tell me that, if Google's 582, I code the 620 strikes, 18 delta. That says to me I've got maybe an 18% chance that Google will be at 620 within 22 days. So that's a really great little free tool for you to use. So using this probability analysis, it provides a trader a great trading tool for determining price targets to trade against, and it's free. So based on math of probability, you can see that approximately, theoretically 68.2% of options bought will expire worthless. And based on this, it's a really good idea, in my opinion, that traders or investors consider also selling just as much as you look at. And it's going to be this added option strategy. It can really make a dramatic and positive difference in your trading performance when you use it correctly. Now, the next step is, okay, well then what's the right income strategy for me to use? And it's the goal of every trader, again, to select trades based on what's going to provide, consistent positive returns and not always that great return, that home run. And one way to do this is first knowing the income option strategies that are available, and then you want to select the one that best fits your style, your trading plan, your capital. And everybody here in the room has a different capital amount of size, so it's going to be different for everybody. You have different hours that you can trade, etc. But the main income strategies that are out there will be the covered calls, calendar spreads, diagonal spreads, long iron condors, and credit spreads. These are the typical ones you use, and they're all really good, but some are more suited for certain market conditions versus others. Now for me, my favorite income option strategy from those is the credit spread, and for three basic reasons actually. They can work regardless of market direction, so that's a really cool thing. They can almost always work even if you're wrong. I love that because we're always going to be wrong at times, right? And the probability is theoretically 68% even without adding technical analysis, which then can even increase your probabilities more. So it's a pretty interesting concept and trading strategy. And there are three basic types of the credit spreads. You've got the bear call credit spread, the bull put credit spread, and the long iron condor. Now the bear call credit spread is best to use if you think the market's going down. It's a bearish strategy, and all you're doing is selling one call with a lower strike while simultaneously buying another call with a higher strike in the same month, all at the same time as a spread. So you're hedged. And this is an example of what that looks like. So here is this is the SPX, which is S&P, and it's trading down here about 1988. And you think that it's going to go sideways. It could even go up a little bit, but you don't think it's going to go up much or down. So what can you do to take advantage of kind of a sideways to up to down slightly or down a lot? You could sell up here, the 2045 strike by the 2050 $5 wide spread. See how far above that is? It gives you a lot of space in case you're wrong. And for doing this, on this is a credit spread, so you receive on this $100 for selling that for 2045, 2050 spread. You get $100 credit. The difference is your margin, capital at risk of $400. So that's what's at risk. Now, if you're wrong and it blows through, that green line, you lose 400 if you don't do anything. But if you're right, it stays below that red, you pocket the 100, you keep it, and that's a 25% return. Not a bad return. Now, the next one is the bull put credit spread. And this is best used when you're bullish on the market and you think the market's going to go up. And it's basically just selling a put while simultaneously, again, buying another put with a lower strike in the same month. So that's your hedge. So it's a hedged short premium type or premium collection strategy. And here's the example for this. Now this is on Win, and it's trading like here about $207. And you think, oh, it's going to go up. So you can either buy the stock, you can buy options, calls, call spreads, whatever, or you could do a bull put credit spread out of the money, and you can look how far down below that is. You're short here the 187 put, below it long the 182, so you're hedged. And look how far below the market is, trading at 207. So bullish strategy, and now the market, if it doesn't go straight up and comes back off, as long as it closes above your short strike, you keep that $130 credit you received. Your maximum at risk is 370, so that's a 35% return as long as it closes above your short strike. So not a bad return there as well. Now the next one is the long iron condor, and it's kind of a non-directional low-risk strategy, and all it is combining that bull put credit spread with the bear call credit spread. And you can leg it, which is another nice thing about it. So here's an example on Amazon, and it's just kind of trading sideways, going nowhere, kind of like it is almost right now. And so to take advantage of this sideways price action, you could sell that bear call credit spread there with your hedge, your long up here, and the bull put credit spread down here. Sell those together as one spread, or you can leg it. So if it comes up here, put the bear call on, comes down here, bull put. Now on this as a straight spread, you collected $150 right there, credit, goes straight to your bank account. The difference is a $500 wide spread, $350. That's your margin. That's the at risk. If you do nothing and you're wrong, that's the most you can lose without any kind of adjustments. So that's not a bad trade, and that's a 43% return on your capital at risk. Now, this will show you, and this analysis will show you the difference between just a long directional option, the strategy 1, just buying calls, and strategy 2, selling an out-of-the-money bull put credit spread. So both are going to be bullish strategies, but you're going to see the big profile difference between the risk. Now, this is again back on Win. Now this was the two strategies. Win is strategy 1. It was trading at $207, so you're bullish. So you buy the at-the-money calls, the 207 calls, $11.40 per option contract, so that's $1,140 for one contract. So for some of us, or a lot of us, that might be a lot of money, $1,140 for one option contract. So if you did 10, that's starting to add up. But the good thing is, you have unlimited upside potential. You can make some really big money. It is defined risk, so all you can potentially lose is the max that you paid out. So that's okay. But it can be expensive, and you're going to see the difference in risk here in a few minutes. Now, strategy 2 is also bullish, but this is selling an out-of-the-money bull put credit spread, and it's selling the 187 put, buying the 182. So when it was done, it was below the low that Win had traded, and it was also 9.5% below where Win was trading at the time of execution. So strategy 1 is just buying those straight options. Now, you'll see the difference here. You're looking for it to go up. Well, it did first go up, So you bought those options right there. But then all of a sudden it just craters to the downside, which, we'll see that quite a bit, where the market just kind of waterfalls down. Now, all of a sudden, you bought it here when it was trading at 207, and you paid $1,140. Now you look at your P&L on May 8th, and it's trading right down here. You open it up, and you're down $583. Well, it didn't take long, and you're down quite a big chunk of money. Now, on May 21st, it starts to come back up, and it's trading right here at about 205. But you look at your P&L again, and it's still down 518. So it really didn't recover much. So kind of a bummer trade in that standpoint. Now the next trade, you could have done strategy 2, which was selling that bull put credit spread out of the money, and this you collected $130 credit. Max at risk is the 370. So let's see what happens here. So you can see where you sold this particular trade down here, way down here, below that low, and that was like 9% below where it was trading at the time. So you look at that, and then you look to these different scenarios, and you see here when all of a sudden it's down at 196, you open your P&L up, but on this trade you're down only $38.50 versus straight option calls being down 583. Huge difference there. Now on the 21st, you look and you open up your P&L, and you look at your P&L, and actually now you're up $78.50, but the other strategy is still down 518. So that's the huge difference between these two strategies. They're both bullish, but one really defines your risk a little bit better. Now, I also call this the most forgiving trading strategy ever, and that's the credit spread. So here's just another example to kind of illustrate that. Now, this was on SPX, which is the S&P 500 CBOE, and this was entered on the 26th of May. Now, the trade, the way I like to do these trades is that I use my model, my cycle indicator. So when my momentum is shifting down, then it's been hard to short this market for the last year, 2 years, right? I mean, you'll go down and then you'll bounce up. You go, it doesn't have any sustained movement to the downside. So, finally you figure it out. And the better way for me to be trading to the short side has been to sell the out-of-the-money bear call credit spread. So when when my system says go short, I just sell, try to sell one standard deviation above where it's trading the bear call credit spread. So here was selling that the 2150, 2155 bear call credit spread, 23 days to expiration. Now, even if it goes up a little bit, the time decay is going to really be in my favor, which you could see. So here's how that trade, worked out. So you can see how far above the market is. That spread, you're sold it way up here, and the market's down here, and they're moving that way. So I call these low stress trades as well. So you don't have to worry about it too much. Once you get that initial movement for a few days, and that time decay sets in, you're doing pretty good. Now here's kind of what it looks like. So by doing that spread, it was a $5 wide spread or $500, collected $110 right there. And then the difference is your capital at risk 390 or the margin. So if you're right and the thing expires worthless, you end up keeping the 110. Your max at risk was 390. That's a 28% return. These are nice little returns. So it was expiration was on the 18th, and it expired below my short strike, and so it was full profit. So 2150, 2155 bear call credit spread. You do one contract, or you do 10, or as many as you want. So that's what it looks like on your option profile when you're looking at it. Here's your short strike right here at the 221.50, and here's your long. So you're hedged, and you want it to go down like that. So it expired worthless, and that was a nice return, $110 per option contract, and not a lot of stress to it. Now, another really cool way to do these things from time to time is what I call it's a vertical credit spread. You can do it on puts or calls, but it's what I call a positive risk ratio. So you can actually reverse the ratio. So see when you're doing an out of the money credit spreads, you've got what we call that negative risk ratio. So you could see that for example, when you were getting $130 credit, that would be your profit, but you're risking 370. So it's a negative risk reward. But when you go in the money, you can reverse that, and you could potentially reverse it to being totally the other way around. So it's just another way to look at it, but it's interesting to use at times. So this is something that you can use when you have a target price and you're very, it's good for really kind of breakout target price directional type trades. So I just want to show you an example of what that would look like. And this was on Baidu, and it looked like a really good bullish setup, positive momentum, trend line breakout, etc. So you could have just bought stock, you could have bought calls. It was in what we call a volatility squeeze here, just really tight, wound up market, potentially to break hard to the upside based on momentum. So you could have done a lot of things, but the other one concept or one trade you could have also done was selling a deep in the money bull put credit spread. And in this example, it was traded at 219.5. These are weekly options, so these can be very short duration trades. And so you put the short leg in on the put side at 222.50. Market was at 219. That's $3 in the money. So you want this thing to really explode to the upside. Now, by doing it this way, you reversed your risk reward, and you were able to get $181 credit into your account. The difference in the spread was $69 at risk. So, if it expires over your 222.5 or thereabout, you're going to, keep that full credit, and that would be a 262% return or a 2.62 to 1 positive risk ratio. So, there's your credit, here's your at risk, and then it's a matter of, this thing's settling above your short strike. And, if it does, you make a really great payoff. So it's a directional bet, but it's got a positive risk ratio. So the negatives to it is you've got to watch out for assignment. But, since you do have time value in these options, that's very unlikely until, expiration. Or you need to be careful if there is some type of dividend or something. So you always check for that. Now here's another credit spread that I like. This is I really like to do these when they're 1-to-1, and this was just last week on QQQ, and it was basically a day trade. So QQQ, this was doing it at the money, basically 109.50, 108.50 bull put credit spread. So I was looking for a move to the upside, and you'll see how this was structured at 1-to-1. So you're risking, in this particular case, $50 to make 50. So here was a nice, push to the upside. You can remember that last week. It was right, I believe, after the Fed meeting. We had a nice pop to the upside. We kind of had that doji candle right there, and then we had that fall through. The next day was up. So right here I had positive momentum. So for this trade, basically on the 17th, it was trading 109.25. So sold the 109.50, bought the 108.50 bull put credit spread. It was about 25 cents in the money, and it was. The other great thing with options now, a lot of times, a lot of these different options will have 50-cent wide strikes or dollar wide strikes. So this one, was $1 wide, and so you risk 50 to make 50. So it's 1-to-1. So nice risk reward, and you can use that kind of as your stop. So you don't have to really do anything else. And so it closed above. It closed at 110.70. No, I got out before it closed because it spiked straight up and got out at $9. So, put the thing on for 50, received 50 credit, covered it back when it, dropped down to 9. So that was a $41 per contract profit in one day, which is 82% return on your capital at risk. So these are some really different things to look at for your trading. It's not something a lot of traders will do just these credit spreads. Period. Various different credit spreads, iron condors and butterflies and all that kinds of stuff. So it's something to add to your toolbox of trading. And some traders just do this 100%, like Karen the Super Trader. But it's something that can complement what you're currently doing and add some diversification. And the one way that this really can help you add diversification is for position sizing. So let's say you have $2,000 to put on a trade. Well, instead of putting that full $2,000 on just buying stock, or let's say $2,000 buying calls, you diversify and you buy some call spreads, but all money bull put credit spreads if you're bullish, or if you're bearish, bear call credit spreads, because those probabilities, theoretically, as soon as you put that trade on without any kind of directional indicators, you've got a 68% probability of winning. So it really lowers, is a great way to diversify your trades. So, wanted to share this with everybody here. I'm sure a lot of you guys are probably trading these right now, and maybe you're not, but it's just a different way to look at the markets, and it's a really good complementary type of trading strategy, and it's not that complicated once you just, understand the basic concepts that are involved in this. So if you have a minute here, just read these couple of these nice comments I got from some of my members. It just kind of gives you a better feel for, what I try to provide, and then we'll move on. Seeing a lot of great questions. So I'll get to those just in a couple seconds here. One of them, would you defend a credit spread by converting it to a butterfly? Yeah, that's a great defensive strategy, is to convert it to a butterfly, because these are all vertical spreads. So there's, once you understand what the vertical spreads are, then you can add other verticals to them, and they're really pretty interesting the way you can shape the risk. And you do need margin, yeah, but the margin can be very, very small. So, you can see from these examples, you don't have to have a lot of margin capital to put up. And that's what's at risk. It's the margin that's at risk. The stop loss, well, stop loss is a very subjective thing. Now, Stephen just did a great presentation last night on stop loss. So a lot of different ways to do stop loss. And, but, definitely put stop losses on them. My general rule on options, what I'll do is I'll have a couple different stop loss measures, but the one thing that I'll do is if an option trade goes against me like 50%, it's kind of one of my other scenarios, then I just close it out. So if I've got a credit spread on, I got $100 credit, and it goes to 150, I'd close it out. Something like that. You can have all kinds of different ways to look at it. Now, the next, let's talk a little bit now about some other things you can do to generate a more steady stream of income each and every month. And Big Al said this is the way he trades. So, and he's a professional. I saw that he is a professional trader and trading full time. So thank you. That's a good kind of a good support for what I'm trying to put forward here tonight. But so what I'm going to offer you here tonight, and this is a really special package I put together for this presentation, is if you're interested in learning more about credit spreads. I did a course not long ago, and it was 100% on just using credit spreads. It's a 5-hour recorded course, step by step, on everything that you'll need to know about credit spreads, all the different defenses, 6 different defensive strategies, just the ins and outs of what you need to know, the Greeks, what you need to know. And so you'll get the 5-hour recorded course in 30-minute modules, 183-page training manual, plus my 13-option strategy diagram. Now I'm going to limit it to around 30. If I go over, that's okay, but I don't want to do too many, because what I'm going to also add as a bonus for everybody here tonight, the first 30 plus or minus, is what I call my accountability and support coaching Q&A follow-up. So you'll get that, so you can come in a week, well, probably a couple of weeks later after you've gone through the course, you'll have questions. You'll come in and ask those questions. Now, let me give you this link, and then I'll go through a couple more points here and then get into more of your questions. So I'm going to put this link here. And so just put that, it's powercycletrading.com/start. Just put that in your URL, and that will pull up this payment link. Now, the other thing I'm giving to you, this is a pretty awesome offer actually. It's a 2-for-1 special option course package. So one, you're getting the trading credit spread for income course, that 5-hour course, 183-page manual with it. Plus, I'm going to throw in for the first 30 here tonight a bonus course. I just did this course about 3 weeks ago, and it's high reward, low risk option butterfly course. Now, if you're not familiar with the butterflies, broken wing butterflies, iron butterflies, this is a 4-hour course just on these option strategies. So it's really a great strategy. So if you're not using this, check it out. You may want to, you may not, but the great thing is you can get all this tonight, first 30 for $97, and here's the link again. Plus, the other good news is that if you don't like it, just send me an email and we'll give you a refund. So it's a win-win situation for you. You can get these 2 courses for the price of one, $97, cheaper than going for a steak dinner, and you can't even do that anymore. Plus a follow-up accountability Q&A in about 2 to 3 weeks once you've had time to digest these courses, which will also be recorded. So you can come in, you can send me the email ahead of time with your questions, and we'll go through your questions. We'll go through trade setups and all that kind of stuff. So it'll be a really good learning experience from just an actual hands-on type situation after you've taken the course. So in the course, you're going to learn how to use these credit spreads to create low-risk, high-probability trades. That's the thing about it. That's what they're perfect for. And then how to use credit spreads. I love to use them on the SPX, the NDX. Now, these are cool because these are European options. There's no assignment or anything. You don't have to worry about early assignment stuff, and it's a great way to play credit spreads. And then teach you in the course these deep in the money credit spreads, when and how to use those. Then, how to steadily, consistently grow that small account. You could see that the margin you put up on these things can be very, very small. So you can take small accounts and consistently bring in these credit incomes and grow it to a bigger account without a whole lot of risk. Everything has risk, but it's quantifiable risk. And then in the course I teach you 6 defensive strategies. The examples I showed you were not being defended, so you might lose $370, but if you know some defensive strategies, this teaches you what you can do if you're wrong. And then, also how and when to use the iron condor and when not to. That's something that you should know. Now, position sizing, I briefly talked on that, but that's a big thing about how these credit spreads can really help you on your diversification of your risk. And a really cool thing is how to turn that, 70%, that 68.2% probability into an 80 or 90% probability trade. So that is explained to you in the course. Step-by-step guide how to execute the spreads, technical analysis, how to use that. Now, you could use I like to use Fibonacci a lot, so I incorporate that into the course to show you the fib levels that I like to use. But if you incorporate your candlesticks and all that stuff that you learn from Stephen, it's the best of both. You use your candlestick patterns, and then you use some of these option strategies. Man, you're just going to clean the clock. And then the best market time frames for the spreads, when to put them on. I show you how to do it end of the day, so you don't have to be glued to your computer all day long. Now, in the option butterfly course, it goes through the Greeks, just the reviews, what you need to know, theta decay and its impact on the butterfly. The butterfly is an awesome trade strategy, and volatility, its impact on that. And then in the course, the butterflies, the foundation is the vertical option spread. So if you understand the vertical option spread, there's so many things you can do. So I'm going to teach you the butterfly spread, the butterfly spread defense, the broken wing butterfly spread, which is awesome, and it'll show you how to take 10 and turn it into 190, and then the iron butterfly spread. So I'm throwing that in as an extra. And these are just some of the trades I've done over the past. These were just over the past 3 monthly expirations, but these are different butterfly spreads. A Batman butterfly spread, the broken wing butterfly. Now you can see here your capital at risk. These are perfect for a small account. Now this is something to complement your trading. So you risk 20, 30, $50, and you can make some really big returns on a little bit of capital by knowing how to use these various butterfly trades. So credit spreads, butterflies, they're all kind of similar, and so you'll get for 97 bucks, you're going to get some fantastic learning, and you'll be paying for that dinner plus some before you know it. So here's that link again, and let's see some questions here. Okay, let me see. There you go. Okay, let me back up here. The thing scrolls, so I may have missed a few. If you have something that if you've already got one of my courses, send me an email and just explain your situation. So just send it to me, Larry@powercycletrading.com. Because I just see some of the guys here, have some of my courses, so that's great. So send me an email there and just tell me what's going on, and I'll get back to you on any of those questions regarding courses. Let's see. So Big Al says, well worth the money. Credit spreads, I spent 50x that years ago in my training. Oh, so he's saying the 97 bucks is well worth the money. Appreciate that back up there. Yeah, the training manual is you can print it out, and I like paper. I'm a old type of paper guy, so I'll take the training manual, print it out, write my notes all over it, and then the recordings are on those 30-minute modules, and we've got those. They're on the cloud, so you can access those. And this is your course for as long as you want it, so you can come back 2 years from now and just access it, or whenever you want to access it. Okay, so one question is, when you sell premium, what's the implied volatility rank range? The implied volatility, that's one thing that you obviously want to look at. So there are a lot of different ways that you can monitor the implied volatility. Now all the charts and all the platforms, you can just, get your implied volatility. And when you talk about ranking ranges, it just depends on the underlying. Some of these stocks that are higher price stocks, when they have good liquidity, it doesn't take that much. Obviously the more implied volatility, the better. But there are various levels at that where, basically I'll look at, something like a 30% or higher, but a lot of these things, could be up to 70, 80, 90%. So it'll really vary. But, what I look at more than anything, I will just look at the option chain. I'll always look at the credit spreads anyway, period, first, and I'll look at that credit that I could potentially receive, and then I'll look at it as a return on my capital that I have to put out, and then I'm using as my guideline, the basic guideline I'm using is a 1 standard deviation out of the money kind of rule. So that'll be taught to you in the course, and then that way you can combine your implied volatility rankings along with that. Just kind of strolling back through here. Let's see. Okay, here so I've got 30 spots. If I go over, that's okay. But I just want to keep it where it's small enough when I do the live Q&A, I can take in all the questions. Yeah, so in the course, a lot of the course is a lot of trading examples, so I'm kind of a visual learner myself, so when I teach a course, I teach it very visually through a lot of kind of trading setups and examples, and I go through it step by step so you see the math and so you can understand it. Now, what is the preferable platform? Okay, I've been, I've started using Thinkorswim about 4 or 5 years ago, And I love Thinkorswim. Now, I am not, I don't get any money from Thinkorswim or TradeStation or any of them, but I also use TradeStation. I actually use TradeStation for my trading, but I use Thinkorswim, for my analysis because it's a fantastic platform. But TradeStation is great too. Okay, so when a credit spread's going against me, the short strike, they widen it out. Yeah, the market makers widen it. So a 50-cent stop is difficult to get out of. Well, that's going to be part of the market situation. Now, every situation is going to be different. You might have to just anticipate that at times, or maybe it's because what you're trading is too thinly traded. So there are a lot of things that can go into that. So. But the other things that you can do, there are other defensive strategies you can do maybe versus that 50% stop. Or, if it's getting to your 50% stop, it's kind of a plus or minus. It may end up being a 55 or 60%, but those are just kind of a rule of thumb that I use. Okay, great question. What's the knowledge needed for the course? Is it for a beginner? Okay, at $97, it's for a beginner, but it's also for, the professional trader like Big Al. So Big Al could take the course. He may know a lot of it, but he might get some other new ideas that he didn't think about. And that's how trading is. I've been trading for over 30 years, but, when I hear Stephen Bigelow out there talking about candles, I mean, you learn something every day. I learn something every day. So if you want to start trading credit spreads, it's for beginners. And at 97, it's the best 97. This course, well, on my website, if you decide not to buy it tonight, it's 197 on my course. And that's just the course without this bonus butterfly. And the butterfly course is not even up yet, and that'll be 197. Indexes. Indexes sometimes are not very liquid. I mean, they'll get the bid-offer spread kind of wide on you, but you just have to work them. Now, the good thing about the index is that you don't have to worry about assignment, whereas maybe on SPY or some of the others, when they have a dividend, that can be a problem. So the SPX, though, is a good, I like the SPX, but it's one of those that you're going to have to work a lot of times to get your spread. Because the market makers, they'll keep it wide, and then towards the end of the day, if they want it, they'll take it. Yeah, and the gap moves are going to be smaller because it is an index. Yeah, the credit spreads are good for all market conditions. You can do it for just a raging bull market up or down or sideways. That's the thing that I like about the credit spread. It's great for any market condition. The butterfly trading, this course, the butterfly course goes through, it's a really great course specifically on the butterfly, which is a unique spread, very low cost, very defined, low capital at risk type spread. And I take you through and teach you exactly the vertical spreads combined to make the butterfly. And a really cool one is the broken wing butterfly. So it's something that you should really, if you're going to trade options, it's something that you should really definitely explore because it's just going to add to what you're doing, especially for option expiration on the monthly. It's a lot of fun too. Yeah, I mean, if you get assigned, it's just basically, so if you're short an option, like at $200 strike and you got assigned, you're going to be short at $200. So then you just have to work it as either you're long or short the stock. So you have to have a plan for that. So it may be that you're fine being, short or long. It may be that you structured it like that. So these are things that you have to think through. But you're not going to be, I mean, never say never, but, on these credit spreads, you're not going to be assigned the stocks because it's against the buyer. It's carry, time value. It's the carry of the option. It's just not worth somebody to exercise it unless it's for a dividend. It's not worth unless it's a real, if it's a high beta stock. It's not. They're stupid to exercise until the last day of option expiration or let it expire. There's no extra 47. Oh, if you saw the 47, that's a technical trading analysis course. If you want to buy that, you can. It's just a link. We call it an upsell link if you want it. It's just an additional course. It's a great course. If you'd like that, you just click on it, and you can add that to your check out? Well, TradeStation's Thinkorswim is great. TradeStation's great. It just comes down to commissions. Well, the European options, they can only be assigned if there's assignment. They'll last on day of expiration, whereas a U.S. American option, you can assign it at any point in time. But don't get all freaked out about assignment. Like I said, if you're trading a higher beta stocks like a Google or Facebook or those, nobody's going to assign you. They're stupid. They don't know what they're doing if they're going to assign you, because they're leaving a lot of money on the table. They're going to wait till the expiration. So don't. And these credit spreads, they're out of the money. So a lot of them you're doing out of the money. So the only one that you'd have to worry about is the in the money, deep in the money, something like that. But rarely will that ever happen. And if you are, then you're just going to be, long the shares or short the shares, which you may be okay with. You have to understand that as part of the risk, but it's not a huge risk. Yeah, so 50% stop. Let's say I'm long a debit spread and it costs me $200. Okay, so I'm at risk $200 on my debit spread, and let's say that debit spread goes down 100. Well, I'll just go ahead and get out. I'll have other stop loss features. You could use the candlestick type stop loss, stuff like Stephen uses, or moving averages, or various stop loss. That's just another kind of layer of stop loss that I add to what I do. Now, I'm usually out of it before that would even hit, but that's kind of another little rule that I use for money management. Yeah, the SPX options will expire the day earlier, so like on a Thursday versus a Friday. Phone number, what's your name? ZS? ZS, you're in. Just send me an email, but I'll just confirm that you're in. Yeah, okay. So I'm going to write that down. Just make sure you're in, and if I go over, it's okay. I just I don't want to go sell 100 of these and have because I've got other members that I do stuff with, and I've got allotments and stuff that I try to keep things to a certain reasonable level. Ed, if you did not get a confirmation on it, just send me an email, and I'll just make sure anybody that ordered and you have any questions and you feel like you didn't get confirmation, don't worry, I'll make good for you. So just send me an email. You can send it to either me, Larry at Power Cycle Trading, or support at powercycletrading.com. There you go. So now, this course is credit spreads. They're spreads. So, you can also just sell naked options, and that's what Karen, the super trader, and a lot of the professional traders, but you have to have a portfolio margin account, and there's unlimited risk. So, I mean, you can do all these strategies and just sell options, which that's what a lot of the big professional money, they just sell naked. They'll go out, 2 standard deviations out and sell, and so. But this type of trading is for more controlled trading, smaller accounts. So the credit spreads are perfectly designed for that. Okay, so thanks, Ed. He says that it takes a while to get that confirm email, so don't go crazy. If you do have any questions, feel free to send us something to my support, and we'll get it all figured out for you. Now, you won't see the butterfly course on it because that's a bonus, and you won't see the follow-up support Q&A. So I know that tonight, whoever buys tonight, this is coming through this webinar, through Stephen's webinar. So you'll get all the additional stuff sent to you. We'll send you an email with confirms, and then we'll send you an email with the follow-up registration for the live Q&A when we do that. So it hasn't been scheduled yet, but it'll probably be about 2 weeks to give yourself some time to go through the course. So the modules, the recorded modules, will be online. So it's kind of in a cloud, setup that we have, and you'll get a login, and you'll just go there, and you'll have your own little spot with all your course information, and then you can download though the PowerPoint manuals. So they're very detailed. Oh, the other thing too is I give you that I didn't show you. I'll also give you a trading library. So I'm going to give you I don't know where, there's about 40 trades. So I call it the trading library, and there are about 30 trades that you'll get. No, I'm sorry. Yeah, so you'll get a lot of different trading examples that were done with all the follow-up on that. So. All right, well, yeah, here's the link one more time, and just want to say thanks for having me here tonight, and I hope this is some useful information that you guys can take off and start using, and help to complement what you're already doing. Well, thanks for having me again, and any questions, send us an email, and we'll go from there. Yeah, you can.
Larry, thank you. Yeah.
Watch as much as you want. Thank you so much, Stephen, for having me here.
Well, thank you, and everybody. Obviously, you're getting a ton more information than $97 worth. So this is something you definitely want. If you have any interest in options and looking at the different strategies, this is the place to do it. You're not. You're gonna get a ton more information than you ever expect. So, Larry, thank you very much. Lots of great information. Everybody, give it a look. This is good stuff. With that, everybody have a good evening. Larry, once again, thank you, and we'll see everybody in the chat rooms.